Dear friends and investors, welcome to our monthly video on investing and markets. Well, it's celebration time. The Nifty has hit a new high of 20,000 plus, and that's good news for all of us. However, as you know, every time the Nifty hits a new high, there is a question in investors' minds: what now? Should I invest now? Is the market too high? Are the valuations too expensive? And I thought that I will quickly set the context so that we can take a very educated call on whether the Nifty hitting a new high is something that we need to worry about. So let's step back and go back to the time just before COVID. The Nifty in Feb 2020, just before the COVID correction, was at 12,200. And now the Nifty is hit 20,200. So the Nifty is up about approximately 65% from the pre-COVID highs. However, if you look at the Nifty earnings picture, the Nifty EPS in March 2020 was 451, and the Nifty EPS expected in March 24, that is in 4 financial years, is about 923, which is a 105% increase. So broadly, what we are saying is that Nifty earnings have doubled in the last 4 years. However, the Nifty is up only 65%. So we believe that the markets aren't expensive as everybody in the media and the chatter makes it out to be. We believe there is a lot of catch up that needs to be done. And a large part of that is because we've seen very robust earnings growth in the last 4 years for India Inc. Having said that, let's summarize what happened at the end of the second quarter earnings season, which is September end. Last month, as you know, we did discuss about the numbers because roughly about 70% of the companies had already come out with their earnings. Now we have the full picture as the full 100%, all the results are out. And if we look at the top 500 companies or the NSE 500, then what we see is that the top line growth was about 2.3% on a year-on-year basis. However, PAT or profit after tax grew by a robust 36%. And if you take the financials out, then the PAT has grown by almost 48%. And this quarter, compared to last year's same quarter, we've seen a positive swing of 500 basis points in EBITDA margins. And as we have been saying for quite some time now, that the real story in the current year is that all the margins that we lost have been now recouped by the end of this quarter. So from here on, we are kind of even Stevens. We lost margins in 22, we regained it back by the first half of 23. And therefore, the broad rally that we've seen from April onwards up until recently is actually backed by very fundamental earnings growth and strong numbers. Having said that, as you all know, that we also had the GDP numbers that came out for the second quarter, and that was a robust 7.6% growth, much higher than what the RBI or all the economists had expected. And that gives us the confidence that the economic momentum in India continues to be very, very strong. What is to be noted is that one of the reasons why the GDP growth was so strong was because of a very strong show by manufacturing. Manufacturing growth actually grew by 13.5%. So all the while that we've been talking about a manufacturing renaissance in India, we are now seeing that backed up by numbers, right? Having said that, Let's now move on to a couple of important sectors, and we will talk about a few names in those sectors where we have an exposure in our client portfolios. If we start with autos and auto ancillaries, we will find that the auto sector had very strong demand revival and weaker commodities led to expansion in margins. There was a constant trend of premiumization and the chip supply situation also improved. So a combination of volume growth, premiumization and softer raw material costs meant that companies posted very robust growth in profitability. Notable among them was Tata Motors. The management raised their FY24 EBIT guidance from 6% to 8%, and that was very comforting. As you know, they've already given a guidance that by end of FY24 they will have a net free cash flow, and by end of FY25 Tata Motors will be completely debt free. So the turnaround continues to be sustained, and in fact the second half looks to be better than what we've seen in the first half. Coming to TVS Motors, which is one of the leading two-wheeler companies, the company plans to expand into new geographies to gain momentum in exports and is also expanding its capacity in e-two-wheelers to 25,000 units per month. And despite the very sharp cut in the FAME 2 subsidies, there was a subsidy that the government was giving for e-two-wheelers, and the government has taken away those subsidies now. Despite that, the management indicated that for their e-two-wheelers, they are still making margins and it is a profitable business. So both OEMs have shown a pretty strong showing. Coming to the ancillaries and Schaeffler, which is a position that we have, the results were a tad soft than what we expected, and the softness was largely a result of degrowth in exports coupled with muted growth in the industrial segment. While automotive grew double digit, it was a slowdown in exports which was reflected because of lower demand in Europe and China. However, the wind business saw a sharp recovery, and we think that that will continue to grow in the couple of quarters. So we are still keeping our faith. We believe that Schaeffler will be a big beneficiary of the growth in the renewable energy sector, in railways, in industrials and in automotive. It may take a couple of quarters for exports to bounce back, but I think the overall picture is fairly robust. Coming to the second automotive ancillary that we own, which is Mahindra CIE, again the second quarter numbers were a little bit tepid, largely because the company had to pass on the softer steel prices to its customers. There were some delays by customers in starting new programs. Tata Motors is one of their large customers, and currently Tata Motors is in the midst of refurbishing its new EV line, and therefore they were drawing down inventories, but that we hope will be corrected in the third and the fourth quarter. Having said that, while the top line growth was a little muted for CIE, the company has delivered extremely well on margins in a very tough environment. The EBITDA margins of the company have improved from 8% to almost 16% in a matter of 3 years. And the company also divested one of its low profitable German truck forging business, and that cash should also come back into the balance sheet. So on the whole, the fundamentals remain strong, and we believe that the softer top line should come back in the next couple of quarters. Now coming to a sector which has really done well on the markets and even fundamentally is the capital goods and manufacturing sector. And there, if we look at it, the demand has been very robust. and order books have been bulging. If you look at L&T, it has outperformed its order intake guidelines, and we believe that it will easily beat its own guidance of 12 to 15% revenue growth. Though the company has been a little bit conservative on margin guidance, we believe that if revenue growth is better than what they have guided, the margin should also follow. Coming to the EMS company, Dixon. Well, Dixon is actually firing on all cylinders. The company delivered a stupendous growth in the mobile segment. Mobiles grew 77% year on year, and there were new order wins from Jio for their feature phone, and they continue to do well for Motorola and Nokia, and they've also won an order from Xiaomi, which is one of the largest smartphone manufacturers in the world. Having said that, it is also one of the companies that has been approved in the list of PLIs for IT hardware, and they've already started manufacturing laptops for Acer, and we believe that there will be some new wins in the IT hardware space for Dixon as well. Coming to ABB, well, what do we say? Every quarter has been better than the previous quarter, and this is the third straight set of superlative earnings that ABB has delivered. There was a robust 31% year-on-year growth in revenue, 100% growth in EBITDA. There was a 600 basis point improvement in margins and an 80% increase in profits. Order inflows also increased by 14%. Now, this could have been better, but for the fact that there was some deferral in finalization of a couple of orders in process automation, but that we believe should come through in the subsequent quarters. Lastly, if we look at HAL, HAL, as you know, is one of the leading players in the defense aerospace industry, and it has a very robust order book of 82,000 crores, which gives it a very strong 3x visibility of revenues. We believe that the long-term order pipeline continues to remain very, very robust. So whether it is the Tejas Mk2, the LCA, the IMRH, the Advanced Light Helicopter, we believe that all of these products cumulatively could have an order opportunity of almost 4.5 to 5 lakh crores. The Defense Acquisition Council has released orders across various sectors of 2.2 lakh crores. So we are seeing that the government is keeping the momentum of orders in the defense sector, and also the fact that all these orders are going to domestic companies, whether they are PSUs or private. And we believe that HAL will continue to be one of the big beneficiaries of the modernization of the Indian Army, and given the geopolitical situation, there will be continuous strong ordering for fighter aircrafts and helicopters. Lastly, if we look at Hitachi Energy, Hitachi delivered very strong order book. However, the margin uptick that we were expecting didn't happen in this quarter, but we were quite enthused that the ordering continues to be very strong. And usually for capital goods companies, the second half is very strong, especially the fourth quarter. So we believe that as revenue momentum picks up, the margin uptick shall also happen. Moving to FMCG and consumers, Varun Beverages continues its fantastic streak of superlative execution. The company delivered a robust 16% top line growth, and international business delivered a 45% top line growth with a 163 basis point improvement in gross margins and almost an 80 basis point improvement in EBITDA margins. We believe that there are several levers for growth for Varun. While the stock has done very well, we believe that it is moving deeper into international geographies. They've just set up a 100% subsidiary in South Africa. South Africa is a very large market. We believe that over the next few years, they would want to increase Pepsi's presence there. While in India, they will continue to grow in juices, which is Tropicana, sports drink, which is Gatorade, which this quarter actually grew by 100%, and value-added dairy products. Coming to United Spirits, also one of our larger positions, they delivered better than expected numbers, and the premiumization trend is well on track. However, they were a bit cautious on their guidance for the third quarter, which we thought was very surprising because our channel checks tell us that the festive season has been very, very strong. So we believe that the management is just trying to be a little more conservative. Having said that, the company delivered a very robust value growth of 13%, volume growth of 4%, and we have seen a gross margin expansion of 400 basis points. So we believe that United Spirits should also do phenomenally well. So on the whole, if you really look at the picture across sectors, across companies, yes, there has been some softness in certain areas, but by and large, most of our companies have either met or exceeded expectations. And therefore, we continue to remain extremely positive on the way the portfolios are positioned. And we hope that this robust performance in Q2 will get carried forward to Q3 and Q4. So for now, this is all. Until next time, thank you.